The rise in interest rates we've seen over the last 12 months has completely changed the game, and it is now very difficult to make buy-to-let work in the south of England, but the very opposite is true in the north. So therefore, it is still possible to make returns in property. You just need to pick your location carefully. So despite the headlines, it is very much a divided and nuanced market we are seeing in the UK at the moment in terms of whether prices have fallen or grown over the last 12 months. Looking at yields, looking at cash flow and returns, all of those things have a different picture compared to north versus south, and that's what I'm going to be talking about today. So why have interest rates changed the game so much? Well, as I've talked about in other videos at length, the interest rate rises have led many to question the viability of buy-to-let, but it's a little bit more complicated than that, and we need to go beyond the surface level. Where this is hardest is on higher value properties, which have consequently large mortgages, because it is those properties when they come to refinance, or if people are purchasing them, that they are going to really feel the pinch a lot more in terms of the percentage increases we've seen in interest rates over the last 12 months. Because of the base rate rises in interest rates, this has seen many mortgage products potentially increase by 3 to 4%, and it is hitting those property investors with large mortgages the hardest, and it is those investors in the south of England that have buy-to-let where their property deals are now very likely to be making themselves a loss and having a negative cash flow every month. Despite rents rising at record rates, mortgage rates have increased significantly higher, and it's caused a deficit there, and that is why so many landlords in the south are going to be facing negative cash flow when they come to refinance or when they're looking at purchasing buy-to-let deals as things stand. So I think it's worth looking at an example of the numbers of a typical buy-to-let property in the south to show how the pace of change in terms of interest rates is way ahead of any rent rises, despite those being at record levels. So if we look at a purchase of 400k for a property in the south, now 12 months ago you could have got an interest rate of 3.25%, so that would have meant a monthly mortgage based on a 25% loan to value of £812. So fast forward a year, we're now at a 6% interest, so this is now at £1,500 per month. So a doubling pretty much of that interest payment. If we look at the rent on this type of property, would have been £1,500 per month. Now, rents have increased by 6% over the last year. So now that rent is at £1,590 with a 6% increase. So if we look at the costs of this to compare and see what impact that has had, if we look at all the typical costs for a rental, so we've got voids at 5%, we've got repairs and maintenance at 5%, and then we've got management at 15% plus VAT. So then we're looking at £79.50, that's £79.50, and that is £286. So that is a total of £445 cost, plus your mortgage of £1,500. So that equals a total cost out of £1,945 per month. That means you have a deficit on this property because your rent is 1,590, your costs are 1,945, equals a deficit of minus £370 per month. So you can see the typical deals now in the south don't work because of those increased interest rates just taking so much cost out of these deals, and rents haven't caught up. Second way that interest rates have changed the game is in terms of demand and supply and the prices that people are prepared to pay for property. So as you can see from the data on screen, which is from Zoopla and their price index from September 2023, there is a complete north-south divide at the moment in terms of year-on-year change for property prices. London and the south of England have actually fallen in price by 1 to 1.5%, whereas the north, in complete contrast, has increased from 0.5% to 1.4% in Scotland. This is what I always say in terms of the headlines from the media that show an overall overall dip in property prices, but don't actually show the regional nuances, which you can see here. What has happened is that due to the interest rate rises, this has caused both first-time buyers and landlords looking to purchase property in the south to actually have a cap on the amount that they want to spend on a property, because these buyers are unable to afford the higher mortgage payments on a monthly basis. And therefore, this has dropped demand in general, as you can see, which has then led to a price fall overall year on year. And those who are still in the market are just prepared to pay a lot less, which will help to bring their mortgage payments a lot lower. And if we look to the north, the opposite is true. And I think that a lot of this is also caused by the fact that those people that are looking to invest in the south are now looking to invest in the north, because that is where you can still get positively cash flowing properties. So investors are increasingly looking at the north, so that's increased demand. And then anyone that was investing in the north anyway is still investing, so that's caused a surge in demand, and that's why prices have actually risen. So in terms of the impact of these interest rate rises, the north has very much come out on top compared to the south in all ways. So the third impact of interest rate rises is on returns, because as I mentioned, mortgage interest payments have pretty much doubled for landlords, as seen in that example earlier. So whereas we were seeing interest rates of potentially 3%, 3.5%, we're now seeing mortgages around sort of 5.5%, 6%, depending on your circumstances. So that's very much a doubling in 12 months, which has had such a significant impact. So let's look at a couple of buy-to-let deals to demonstrate the impact of these interest rate rises on the north compared to the south. So to illustrate the point, let's look at a typical deal in London. So the property is purchased for £450,000 and it has a rent of £1,800, which has a gross yield of 4.8%. Then factoring in the usual 5% for voids and 5% for maintenance and the management fee of 12% plus VAT, and with an interest rate of 5.5%, and all of these are your costs, this property actually ended up losing money. So minus £555 cash flow per month, which is a big loss. And if you were an investor, you would think that buy-to-let is completely destroyed and you would want to sell this property. So let's take a look at a deal in the northeast where I invest. So we were looking at a purchase price of 80,000, monthly rent of 650, which gives you a really good yield of 9.75%. Then looking at all the same costs as we factored in earlier, so 5% for voids, 5% for maintenance, and for management as well, 12.5% plus VAT. And an interest of 5.5%, of course, is all of your monthly costs. This property actually cash flows and makes a profit on a monthly basis of £217. So of course, you're certainly not going to be able to buy an island with this or be able to leave your job just after one property, but it will be passive income and provide a really good return on your money given the strong yield. If you're enjoying this video today, I really appreciate if you could subscribe to the channel and comment on the video. Let me know what you think. It'd be great to hear from you. So as you can see from these examples, it is the north who is winning this battle of north versus south in terms of the best places to invest at the moment because of the higher yields that have always been there. There's some parts in the north where you can get yields of 8, even 11%. And it is those that are bringing that positive cash flow that you would have seen on that example. And this is not the only area where the south is losing out to the north, because if you look at some of the predictions in terms of capital growth over the next 4 to 5 years, a number of analysts, including Savills, they're predicting higher growth in the north compared to the south. And those predictions are very much based on everything that we've talked about in today's video. The fact that demand in the south is going to be suppressed and prices are likely to be in the negative or stay stagnant compared to other years, and demand in the north is likely to stay at the heights it is now, therefore increasing the growth potential over the next few years because of that higher demand. And we all know what higher demand means. It means higher prices. So again, another big tick to the north compared to the south in this battle. Thank you so much for watching this video today. Really hope you found it useful. If you have, can you do me a favor? Can you subscribe to the channel and like the video and put any comments? I'd love to hear from you about what you think about the north versus the south and where you stand on this debate. Thanks in advance.